Few traders would disagree about the benefits of using a stop loss. These can get you out of a position when the price action turns against you, and the initial reasons for opening the trade are no longer valid. However, backtesting will show that for many strategies, the introduction of a stop loss also reduces the overall long-term performance of the system. So what can you do about this? Stay tuned. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. If you're a talented trader looking to attract investor capital to your strategies, Darwinex is the fastest way for you to do this. We enable traders to raise third-party investor capital and then charge success fees on high watermark profits. Additionally, Darwinex itself invests in its traders with our seed capital allocation program that allocates up to 90 million euros per year in successful trading strategies. So, if all of that sounds interesting, learn more by clicking on the link here, or you can find further links in the description right below. Now back to today's tutorial. This episode covers a dilemma that many traders can face. Backtesting shows that stop losses can negatively impact the overall long-term performance of some trading systems. But you still need a stop loss in order to protect your account, right? So what can you do? Well, an approach that I choose to use for some of my strategies is what I call an emergency stop loss. This gets me out of a trade when absolutely necessary, but otherwise, for the vast majority of the other trades, it uses alternative exit rules that can mean the overall long-term performance remains much better. Get this technique right and it can have a dramatic effect. Let's take a closer look. So the dilemma that I'm talking about can probably be summed up as that between risk management versus strategy performance. Now, I once heard another trader articulate the argument for this very well, and he used the example of insurance. If you buy insurance for your car, that might cost you, let's say, $300 or $400. And in a normal year, you probably won't need to claim on your insurance. You won't have any accidents, your car won't be broken into. And so you could look at this as though you'd incurred that $300 charge with no benefit. You didn't actually need it that year. But of course, you don't know when you will need it, and so you have to take out that insurance. Now, the reason this is analogous to stop losses is that over the long term, insurance companies take more off their customers in premiums than they have to pay out for insurance claims. Otherwise, they wouldn't have a business model and they wouldn't make any money. So in the long run, the average person will lose out with insurance. And it's a bit like that with stop losses in trading strategies. In the long run, the stop loss will impact the performance of the strategy. But just like with insurance that you pay for, it's there when and if you need it. So what I'm going to illustrate today is, if you like, a compromise that I use that hopefully gets the best of both worlds. It gives you that account protection, but also enables you to retain a high level of performance regardless of that stop loss. Now, first of all, we have to look at why a stop loss degrades performance. And this can be explained, I think, in terms of the direction of the price action in relation to the direction of the trade at the time it closes. Let me explain. Let's say we open a trade at this level here. And in this example, this is going to be a long trade, so we want price to increase. Now, let's say we set our stop loss level down here. And so the price from the point of entry might go in our favour slightly, it then might come down, and it might move around as price action typically does, and then eventually hit our stop loss here. And the price action is moving against our position at the time it closes. And of course, the more times that positions hit the stop loss, the more dramatic the impact on the performance of our strategy. Now, let's put some context around this. Let's think of this in terms of a mean reversion strategy within a trading range. So the bottom of the range might have been here. The top of the range is here. And so we'd maybe waited for price action to come down to this point and bought here in the hope that price was going to go up to this level of resistance here. But of course, as we saw, that didn't happen. And actually we had a breakout, a pullback to the level of what was support and is now resistance, and then a new downtrend started, meaning our stop loss was hit. Now, this concept of an emergency stop loss means that on the vast majority of your trades, the emergency stop loss won't be hit at all. And that's because we set it further away than we would do for a traditional stop loss. And so, as an example, we might set it all the way down here. But the important thing is that in conjunction with this, you determine rules that will get you out of your losing trade before this level gets hit. And so, whereas with a traditional stop loss, you might expect your stop loss to be hit maybe 50% of the time, and you're relying on a risk to reward ratio to give you a long-term profitable strategy. But with an emergency stop loss, the frequency will be much less. Here, you should be aiming for your stop loss to be hit maybe only 1 in 10 times, or 1 in 20 even. And it's these alternative rules to get you out of your position that will be used instead. So let me give you an example of what those rules might look like. So we'll take away the traditional stop loss. And as we all know, price action never moves in straight lines. We always see this kind of behavior. Now here, the price has reached this level of the emergency stop loss. So if no rules have executed in the meantime, this is our worst case loss. However, let's say that one of the alternative rules for exiting a loss-making trade in our particular strategy uses short-term overbought and oversold behavior. So you might set your profit target here in the normal way below this level of resistance. And if price goes that way, that's great, you'll make a profitable trade. But when the price comes down here against your position and you start to lose money, you activate a separate set of rules based around that oversold, overbought behavior. Now, what this would enable you to then do is to exit your trade when prices were short-term overbought. So that would be at this level, this level, this level, and here. Now look at the difference here. When your position exits at the emergency stop loss, the price is moving against your position. However, if you exit your trade based on the short-term overbought behavior, you'll be exiting your position as price is moving in your favor. And using this type of technique where you exit the majority of your loss-making trades while price is moving in your favor will have a dramatic impact on the long-term performance. Don't believe me? Try it. Backtest this in your existing strategies and see what difference it makes. So the probabilities have now turned around in your favor. Let's say the favorable price move, which is this one, executes maybe 60 or 70% of the time. But then for those losing positions, they're going to exit at various different levels depending on your specific rules, and this might constitute maybe 20% of the trades. And then you might only have maybe 10% that actually reach the emergency stop loss level down here. Now, a word of caution about the risk management side of this. If you're position sizing in order to ensure a maximum loss of, for example, 1% on your account, then you still need to do that using this emergency stop loss level. So you're still providing that assurance of that as a maximum, but very often your loss-making trades will lose less than that amount. So yes, this is a technique that goes against the normal stop-loss strategies that you often see discussed. However, I've found that this has helped me substantially in terms of enabling me to retain that stop-loss, yet still achieving higher levels of performance in my strategies. So that brings us to the end of this particular stop-loss and risk management section of the Trader Evolution series. In the next episode, I'm going to start looking at the concept of whether your broker wants you to succeed or not. And I'll also be covering a whole host of other criteria that you need to look out for when selecting your next broker. But now until then, trade safe.